Hello everyone, I'm Joey and welcome back. Let me ask you a simple question. If you stopped working tomorrow, how long could your savings support your current lifestyle? For many people, the answer is uncomfortable. Some could manage for a few months, others perhaps a year. But retirement isn't measured in months. For many people, it lasts 20, 30, or even 40 years. That's why retirement planning has become one of the biggest financial challenges of our time. People are living longer than ever before. Healthcare costs continue to rise. Inflation slowly reduces purchasing power, and traditional pensions are becoming less common than they once were. As a result, millions of people around the world are asking the same question. How do people actually prepare financially for retirement? The answer might surprise you. There isn't one perfect strategy. There isn't one investment that works for everyone. And there certainly isn't one age when people suddenly become ready. Instead, most retirement plans are built using a combination of different savings and investment approaches that evolve over time. Today, we're going to explore the most common ways people prepare for retirement. Not to tell you what you should do, not to recommend any investment, but simply to understand how these financial tools work and why millions of people use them. Whether you're 25, 45, or already approaching retirement. Understanding these concepts can help you make sense of one of the most important financial topics of your life. Let's begin. Why retirement has changed. Several decades ago, many workers expected to retire with a traditional pension. They worked for one employer for most of their career. When they retired, their employer continued paying them a monthly income. For millions of people, that system provided financial stability. Today, the situation looks very different. Many companies have shifted toward retirement plans where employees save and invest during their working years. Instead of relying entirely on an employer's pension, individuals often take a much larger role in preparing for retirement. This shift has changed how people think about money. Retirement planning is no longer something that begins a few years before leaving work. For many people, it begins with their very first paycheck. The 3 pillars of retirement. Financial educators often describe retirement planning as being built on 3 broad sources of income. The first is government retirement benefits. Depending on the country, many governments provide retirement income programs funded through taxes or payroll contributions. These programs are designed to provide a basic level of financial support during retirement. However, they are generally intended to replace only part of a person's working income rather than all of it. The second pillar consists of employer-sponsored retirement plans. In many countries, employers offer retirement savings programs that employees can contribute to throughout their careers. Sometimes employers also contribute on behalf of employees. These plans often become one of the largest sources of retirement savings. The third pillar is personal savings and investments. This includes everything people save outside of government or employer programs. Savings accounts, investment accounts, real estate, business ownership, dividend-paying investments, bonds, and many other financial assets. Most retirees eventually rely on some combination of these 3 pillars rather than just one. Why starting early matters. One concept appears in nearly every retirement discussion: time. Not because older people can't save, but because time allows money the opportunity to grow. Imagine 2 people. One begins saving in their 20s. Another waits until their 40s. Even if both save responsibly, the person who started earlier has one enormous advantage: more years for investment returns to accumulate. This is why financial experts frequently emphasize consistency over trying to perfectly predict markets. Small contributions made regularly over many years can sometimes produce surprisingly large results compared with larger contributions made over shorter periods. The important lesson isn't that everyone must begin at a certain age. It's understanding that time itself can become one of the most valuable financial resources. Cash savings. Let's begin with the simplest option: cash. Almost everyone starts here. Savings accounts, checking accounts, money market accounts, or similar banking products. Cash provides something extremely important: liquidity. That simply means your money is available whenever you need it. Emergency expenses, medical bills, unexpected repairs, daily spending. Cash is designed for accessibility, not necessarily long-term growth. Historically, inflation has often grown faster than ordinary savings account interest over long periods. That means money held entirely in cash may gradually lose purchasing power over many years. For that reason, many financial educators describe cash as serving a different purpose than long-term retirement investments. It provides stability, flexibility, and emergency access, but it may not always keep pace with rising living costs over decades. Employer retirement plans. One of the most common retirement tools in the United States is the 401k. Other countries have similar workplace retirement plans with different names and rules. A 401k allows employees to contribute part of their salary into a retirement account. The money is generally invested according to options available within the plan. One feature that receives significant attention is the employer match. Some employers choose to contribute additional money when employees contribute themselves. Not every employer offers matching contributions, and the rules vary widely. But when available, employer matching becomes one reason workplace retirement plans receive so much attention. It's important to understand that investment choices inside these plans can differ considerably. Some plans primarily offer mutual funds. Others include index funds, target date funds, bond funds, or other diversified investment options. The specific choices depend entirely on each employer's plan. Individual retirement accounts. Many people also save independently through retirement accounts opened outside the workplace. In the United States, these are commonly known as individual retirement accounts, or IRAs. Some people choose traditional IRAs, others choose Roth IRAs. The difference generally involves how taxes are handled rather than what investments are available. Inside these accounts, people may choose from a wide variety of investments depending on the financial institution and applicable regulations. Again, the purpose of today's video isn't deciding which account is better. It's simply understanding that retirement accounts are containers. The investments placed inside those accounts are separate decisions. That's an important distinction many beginners don't initially realize. Stocks. Perhaps no retirement investment receives more attention than stocks. When someone buys a stock, they purchase a small ownership interest in a company. If that company grows over time, its value may increase. Some companies also distribute part of their profits to shareholders through dividends. Stocks have historically produced significant long-term growth over extended periods. However, they also experience periods of volatility. Markets rise, markets fall, sometimes dramatically. History includes major declines during financial crises, economic recessions, and unexpected global events. For long-term retirement investors, understanding that volatility is a normal part of investing becomes extremely important, because retirement investing is often measured in decades, not weeks. Bonds. Another major category includes bonds. A bond represents a loan made to a government, municipality, or corporation. Instead of purchasing ownership in a company, the investor is lending money for a specified period. In return, the issuer generally agrees to make scheduled interest payments and repay the principal when the bond matures. Compared with stocks, bonds have often been viewed as providing lower expected returns but potentially lower volatility. However, bond prices can still rise or fall depending on interest rates, inflation expectations, and credit conditions. For that reason, many diversified retirement portfolios include both stocks and bonds, rather than relying entirely on one asset class. So, why do so many experts talk about diversification? What exactly are index funds? Why have target date funds become so popular? Should real estate be considered part of a retirement plan? And how do people decide how much risk is appropriate as they get older? So, why do so many experts talk about diversification? What exactly are index funds? Why have target date funds become so popular? Should real estate be considered part of a retirement plan? And how do people decide how much risk is appropriate as they get older? Let's continue. Why diversification matters. One of the most common concepts in investing is diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." That's essentially what diversification means. Instead of relying on a single investment, many investors choose to spread their money across different types of assets. Why? Because different investments often behave differently under changing economic conditions. Stocks may perform well during periods of economic growth. Government bonds may behave differently when interest rates change. Real estate may respond to housing demand and borrowing costs. Cash provides stability and liquidity. No asset performs best in every environment. Diversification doesn't eliminate risk, but historically, it has been one way investors seek to reduce the impact of large losses from any single investment. Understanding index funds over the past few decades. Index funds have become one of the most widely used investment vehicles around the world. But what exactly are they? Instead of trying to select individual winning companies, an index fund attempts to follow the performance of an entire market index. For example, some index funds track hundreds of large companies. Others focus on international markets, small businesses, or specific sectors of the economy, rather than depending on the success of a single company. Investors gain exposure to many companies through one investment. This broad diversification is one reason index funds are frequently discussed in retirement planning. Again, this isn't about saying they're better than any other investment. It's simply explaining why they've become so widely used. Mutual funds. Another investment many retirement accounts offer is the mutual fund. A mutual fund pools money from many investors. Professional managers then decide how that money is invested according to the fund's objectives. Some mutual funds focus on stocks. Others invest primarily in bonds. Some combine multiple asset classes. Some focus on specific industries or geographic regions. Unlike index funds, many mutual funds involve active management, where investment professionals regularly buy and sell securities in an attempt to outperform a benchmark. Both approaches have advantages and limitations. Understanding the differences helps investors better understand how retirement accounts are structured. Target date funds. One investment option that has become increasingly popular is the target date fund. These funds are designed around an estimated retirement year. For example, someone expecting to retire around 2055 may choose a fund built for that time horizon. One characteristic of many target date funds is that their investment mix gradually changes over time. When retirement is decades away, the fund may hold a larger percentage of growth-oriented investments. As retirement approaches, the allocation often shifts toward investments that historically have shown lower volatility. This automatic adjustment is one reason many employer retirement plans include target date funds as an option. Dividend-paying companies. Some companies choose to distribute part of their profits directly to shareholders. These payments are known as dividends. Not every company pays dividends. Many younger companies prefer to reinvest profits back into growing the business. Others choose to return part of those profits to investors. Dividends have historically represented an important portion of long-term stock market returns. However, dividend payments are never guaranteed. Companies may increase them, reduce them, or eliminate them entirely depending on business conditions. That's why experienced investors typically evaluate the overall financial health of a company, rather than focusing only on dividend yield. Real estate. Real estate is another asset frequently mentioned in retirement discussions. Some people own rental properties. Others invest through publicly traded real estate investment trusts, often called REITs. Real estate can potentially provide rental income while also changing in value over time. However, property ownership also comes with responsibilities: maintenance, insurance, property taxes, vacancy periods, unexpected repairs, and changing market conditions. Like every asset class, real estate offers both opportunities and risks. It is not automatically a better or worse choice than stocks or bonds. It simply behaves differently. The role of inflation. One challenge every retirement plan must consider is inflation. Imagine someone retiring today with a fixed amount of savings. If prices gradually increase over the next 20 years, that same amount of money may buy fewer goods and services, food, healthcare, housing, transportation, utilities. Almost every expense may become more expensive over time. This is why inflation plays such an important role in long-term financial planning. Retirement isn't only about how much money someone has. It's also about what that money will be able to purchase decades into the future. Risk changes over time. Another concept many financial professionals discuss is risk tolerance. Risk isn't simply about personality. It also changes with time. Someone in their 20s may have several decades before retirement. That longer time horizon may allow more time to recover from market declines. Someone already retired may have different priorities: preserving income, managing withdrawals, reducing volatility, meeting regular living expenses. Neither approach is automatically right or wrong. Financial circumstances vary greatly from one person to another. That's why retirement planning is highly personal. The biggest retirement mistakes. While every situation is unique, financial educators frequently point to several common mistakes: waiting too long to begin saving, ignoring inflation, keeping all savings in one type of asset, making emotional decisions during market volatility, not understanding fees and expenses, failing to review retirement plans periodically. These aren't guarantees of failure, but understanding them helps people become more informed when evaluating their own long-term financial goals. Retirement is about more than investments. One of the biggest misconceptions is that retirement planning is only about choosing investments. In reality, investments are just one piece of a much larger picture. Retirement also involves expected living expenses, healthcare costs, taxes, life expectancy, emergency savings, insurance, housing decisions, and personal lifestyle choices. Someone planning to travel extensively during retirement may need very different financial resources than someone planning a simpler lifestyle. That's why retirement planning isn't a one-time decision. It's an ongoing process that often changes throughout life. Final thoughts. There is no universal formula for retirement success. No single investment works for everyone. No strategy guarantees future results. The most successful retirement plans are often built gradually over many years through consistent saving, thoughtful planning, and a clear understanding of financial goals. Whether someone chooses employer retirement plans, personal savings, diversified investments, or a combination of different approaches, the most important step is understanding how these financial tools work. Knowledge doesn't eliminate uncertainty, but it helps people ask better questions, understand financial news, and make more informed decisions throughout their lives. Retirement is one of the longest financial journeys most people will ever take. And like any long journey, preparation usually matters more than prediction. The more people understand about saving, investing, inflation, diversification, and long-term planning, the better equipped they are to navigate whatever economic conditions the future may bring. If you enjoyed this explanation and want more fact-based videos about personal finance, retirement, investing, and the global economy, be sure to subscribe. I'm Joey. Thanks for watching, and I'll see you in the next video.